Yeah, I mean, I think it really is. I mean, the job ads, 200,000 on average per month. We're seeing wages in all sectors start to creep up. A lot of people here think it's just the lower end and minimum wage jobs, but we're seeing wage growth across all sectors. And we know that Janet Yellen, deepest in her heart, that's what she cares about more, a lot more than inflation. So, yeah, I think the job market is very, very healthy, or at least healthy enough to raise rates.
And as you say, I guess the inflation, which is still the Fed's key concern, given the upward pressures on wages, as you do suggest there in many sectors, that's obviously suggesting that we could start to slowly see a bit of an uptick in inflation, which would obviously be very much welcomed by the Federal Reserve.
Yeah, I think so, and that's something that's kind of hidden, not talked about much, but over the years, it doesn't take much for inflation to creep its head. And, we obviously have seen oil prices go down by more than 50%, industrial metals, base metals, et cetera. Could they go down further? Absolutely, they could. But I think the odds are better that they stay stable in a tight range. And with wage pressure going on, with better access to debt or capital by consumers, I do think inflation could happen a lot more quickly than most people realize.
Larry, it's Gaurav Sodhi here from Sydney. It sounds like you're almost making the case for not just one rate rise, but maybe further hikes down the road. Is that, am I right in suggesting that might be on the cards?
Yeah, I think it's in the cards. I think we're going to see 3 or 4 by the end of next year. If you look at the Fed fund futures here at the CME, they imply maybe 1% by the end of 2016. That would be my base case. But I do think we're going to see 3 to 4 rate hikes next year, based on the premise that the economy here is a little bit better than expected. We're going to see a lot of tailwinds with consumer discretionary spending, that whole access to capital, which is debt, which Americans love. That said, I do think we'll see some inflation. The job market will stay robust, and we'll see a little bit higher interest rates this time next year than most people realize.
Larry, I guess one of the other big questions is what will in fact happen to the US dollar when the Fed raises rates, because it's obviously benefited recently from those expectations of a hike and easy monetary policy from other central banks around the world. But the Fed has a pretty difficult task, I guess, of managing those expectations and not letting that US dollar appreciate too much further.
Yeah, I think short term, the dollar does have some upside, especially against European currency, against Japan. When we're going to be raising rates, they're loosening theirs. Short term, yes, but at long term or even intermediate term, I don't think it's going to go up much further, faster than it is currently, maybe a little bit more. But the fact is, a lot of it's already built into this market. I mean, I do think U.S. dollar has a valuation problem against the euro, against the yen. Not so much against some of the other currencies like the Aussie dollar, which I've never been right about, but I do believe the Aussie is vulnerable because it is a great candidate for a funding currency, and I do believe they'll start chopping their rates as well. So I think the dollar could be strong against the Aussie in 2016.
And obviously the dollar strength is also likely to weigh on some of those US dollar price commodities, and we're certainly seeing those pressures evident at the moment, but particularly in those sectors dealing with excess supply. Would you be recommending reducing exposure to those commodities?
Well, if you haven't already, it might be too late to do so. It's like I'm constructive with copper, with iron ore, even with oil. I mean, I think there's some value there, but the bigger picture is I think producers have worked so hard at cutting costs and not cutting supply. So that's the central theme behind the fact that I wouldn't be very anxious to get aggressive with buying something like iron ore, copper, or oil, especially in the oil industry, because it's more of a cost reduction thing than it is a supply issue. There's plenty of supply out there still.
We've obviously, very much been focused on the Federal Reserve and this data flowing through and how that's likely to influence the Fed. But now the energy story really seems to be dictating the market at the moment, and it's all commodity driven, isn't it? And it's really churning up a lot of this volatility at the moment.
Yeah, you're absolutely right. This morning, People didn't even realize that China had a PPI deflationary number, import-export number, et cetera. It was all about oil price, and seeing it drop to a psychological low point. It's really gotten people off to a bad footing, and we did open up deep in the red. We have rallied back considerably, but we still are in the red. I think people realize, or they think they realize, that we need to have higher oil prices. And I tend to be an outlier, thinking that ingenuity will continue to lower break-even points, and this is a huge economic boon to the consumer, net a tailwind for our economy.